Welcome to the What to Watch video update. I do a number of videos each week. I do a daily video, I do a number of different weekly videos, and then the last video that I do over the weekend is I pull out those charts that really seem to be speaking to us loudly right now. This changes every week, and you might not understand the context all that much. You have to watch the daily and weekly videos to really see that. But I put together this video to show, at least as of right now, for Monday, September 16th, what is really saying something. And these are the things that we'll be watching as the week unfolds. Now, we had a pretty nice reversal this past week. We're near an all-time high with the S&P, but we're not quite there yet. That's the positive side, and we're looking a lot better with our charts. On the negative side, September and into October during an election year can often be negative. And we're seeing some things that we want to keep an eye on because these are sometimes warning signs that tell us the market is getting ready to be more defensive, which means a decline. So we just take all of the evidence together and reach a consensus. That's the approach that I use. You can't get a real good idea of what's happening in the market by just looking at one or two charts and saying, oh, well, this is going to happen, that's going to happen. No, you have to look at everything. You have to gather as much information as you can, put it all together, reach what I call the consensus approach. Other people call this the weight of the evidence. And then say, okay, are we leaning more positive? Are we leaning more negative? Okay, we're leaning more positive. Here's the things that are justifying that looking more positive. But here are some things that we are a little bit concerned about, and we want to keep an eye on those things because sometimes they can tell us ahead of time that things might not stay positive. If we're getting ready to go negative, we look at those things, all right. And a week ago, most of the list of charts that I have were negative, but there were some positive things too. And so we have to keep all of this kind of in our mind and look these things over because you're not going to get all the answers from just one or two charts. So if you want to see how I update these on a day in and day out basis, watch the daily videos. And I also have a program where I teach technical analysis and my whole approach to technical analysis and other classes like strategies and basics of the stock market and how to deal with mental analysis and so forth. As I said, this is being prepared from Monday, September 16th. There is the program that I just referred to. If you want to talk to me about this, here's an email address. There's also a link that will take you to the website. It's free for the time being. I have a trip coming up here, and so I'm keeping it free for right now and wide open to anybody who wants to come. And I do post additional videos there that I don't put on YouTube or Rumble. And then the daily video is the real foundation of the analysis that I do. If you just watch one of these outside videos, you're probably not going to get the context of what I'm trying to achieve. I know my videos are longer. I know I show a lot of charts. That's all by design. That's after decades of doing this. This is what I found out works on a day in and day out basis. But we need to look at the big picture and then we need to break it down to the smaller picture all at the same time. All right, let's go through and see the things that are positive. Now, this isn't just a blanket positive list. There are some warning signs, even on our positive side, that we want to keep an eye on. It started off the week looking rather negative, but then it turned more positive as the week played out. This is an intraday chart, 10 minutes. This is what I follow while the market is open. And we had that big down day on Friday, September 6th, and we closed pretty much at the low. And then I did the weekly what to watch video a week ago, and everything was really looking pretty negative at that point. Well, there were some positive things that we were seeing even in last week's video, and we started to improve. And we had an up day on Monday. We had another up day on Tuesday. This was just enough, even though we should have been going down based on what our charts are saying to us. It was enough of a positive move up to switch things to a little bit more positive stance. Then right here, right at the open on Wednesday, this is when CPI came out. It came out an hour before the market opened. The initial reaction was we tanked because it came in stronger than expected for the core CPI. Well, then the market gave it a second thought and brought the futures all the way back to the unchanged level. And then we had a flat open on Wednesday. Well, then the cash market decided they wanted to take things slower, and boom, down we went. It looked like, okay, things are really falling apart here. But if you notice, where we set the bottom on Wednesday was right around the same area where we set the bottom on Friday. It tested that low. And then we saw buying really coming in. The smart money, which is what we watch. This is why we look at all these charts. We're trying to figure out the smart money, not the big money like hedge funds. We're trying to figure out what the big institutions do and the people that really control what happens in the market. And then we just jump on and do the same thing they're doing. They started to come in and really buy. They were happy with this test of this low, and they came in. We saw a major reversal that took us through the end of Wednesday and then into Thursday, and we even ended higher on Friday. So this switched the climate that was looking quite negative a week ago back over to looking more positive, at least on the daily charts. Okay. And we're seeing an improvement here. I follow a chart that's a 10-minute intraday chart of the growth to value ratio for the S&P. When we were topping out back in August, and then this was starting to go down overall, that's when the market started to come under pressure. We were still kind of bouncing around here, but then we started to see an improvement. What we're going to be watching for. Can this continue? Is this going to keep going up? That would be more positive for the market. That means growth is outperforming value, and that's what we want in a positive environment. If this starts to roll over and go down, that's going to be a warning sign to us. We're also keeping an eye on our trend. Now, I usually don't show this short-term chart here, but I am for right now because this is the ADX, and this is probably my most primary indicator that I follow because we get a lot of information from this. The black line is the ADX itself. When it's going up or down, that just means the trend is getting stronger or weaker. I put a moving average on here to give it a little bit of context to see, okay, how are we moving up? How are we moving down? So that tells us, are we seeing a strengthening trend or a weakening trend? There's also a static number down here at 20. Now, the charts that we use are often a little bit more dynamic, and they don't always stick around these static numbers. I have found, and if you use this indicator with stocks or sectors, you might come up with a different level. But I found over the years that the level of 20 seems to work for the S&P 500. It might work for 25 for other stocks. I've read books about the ADX and how it's implemented, and my number is quite a bit lower than what some other people have used over the years, but this is what I found works. Well, we were starting to develop a trend here, and we were going above the moving average, and the red line was on top. That's another bit of information we get from this chart. When the red line's on top, that means we're negative, and the green line's going down. Okay, the buying is going away. And then everything started to reverse, and the red line was coming down, the green line was coming up. We actually saw a cross. Well, it takes a while for the ADX to actually adjust, and so it had been going up. It sees this cross happening, and now it's starting to go back down. But a week ago, we were looking more negative. Now we're defaulting more to positive because the green line is on top here. It would be even better if we keep going up to see the green line going up, and then eventually the ADX turn and go above 20 and also cross above its moving average. We're not seeing that right now, but just the fact that the green line is above the red line is positive for this chart. And we see that same basic thing here with the intermediate term. And this is the one that I focus on the most. And all those things I said on the previous chart also apply here. We have the green line above the red line. The ADX is weakening below its moving average, and it's below 20. We want to see all of these turn up with the green line going up if we're going to remain positive. We look at the advanced decline line, and this is looking pretty good here. We're breaking out a little bit above this previous high, and that's positive based on price. We're also looking better here based on volume. One of the concerns over the summer is we were going up with the advanced decline line based on price, but we weren't breaking out based on volume. This is more positive for right now in that we're seeing them both break out above these previous highs. Not by very much, but it is breaking out a little bit. This is also positive because we're above both of the moving averages, and the moving averages are sloping higher. Now, this chart is improving. This is the new highs, new lows, another internal measure that we look at inside of the S&P. We see a lot more green than we do red, but because we've been trailing off with the new highs, as we were chopping sideways there for a while before we took the dip down, This is showing that the 5-day moving average is coming down, and it's still negative, but it's trying to turn up, and the 10-day is still declining, but starting to flatten out. But when you look at this just by the green versus the red, we are looking okay, but we could see some more improvement here if we continue to go up with the S&P, and that would just confirm things being more positive. This is a smart money indicator, and it's based on not only price, but volume. We were negative a week ago. We dropped below this red line, which is the moving average. That's the line between positive and negative. Well, we crossed back above the red line, and then I try with an indicator down at the bottom. I call it the boom indicator. Really, it's just an adjusted MACD to try to simulate how far are we above or below the red line. And we crossed above the midpoint and we're going up. And according to this, we're not necessarily looking extreme right now. So taken all together, this chart is looking positive. We're also positive with the advanced decline ratio. One measure is based on 19 periods, that's short term. And then we look at 39 periods, which is more intermediate term. Both of these lines are above zero and going up, so that's positive. And we break that out based on price and volume. Here is the advanced decline ratio above zero and going up. And we crossed back above zero with volume and also going up and not necessarily getting extreme. When we see really high readings, then we use this like an oscillator to suggest that maybe we're going up a little too far too fast. We're not seeing that yet. And then we have some moving averages that are plotted right on the S&P itself, a 20, 50, and 200 period exponential moving average. They move faster than simple moving averages, and we're going up with all three of these lines. So that's positive there. And we look at the condition of our 20 period moving average. That's what I determined to use for the short-term trend. And this is a double and triple exponential moving average study. And the triple moves faster than the double. And we're going back up with both lines. It's going to be even more positive if we can continue to go up with these lines and stay above them as well. Then we compare that to a 20-period simple and exponential moving average here. And most folks tend to use the simple moving average, but I still plot an exponential moving average here as well. We're above both of these lines, and this has turned the short-term trend back to positive. And we want to keep an eye on the condition of the 50-period moving average. That's what I use to determine the intermediate term trend. We're back above both of these lines, and the lines are starting to go back up. So this is looking more positive. Then I plot all the moving averages here, both simple and exponential, going from 20, 50, 100 to 200. We're above all of these lines. The longer we stay above this, the more the lines will continue to go back up. We were watching the 100 period a week ago. We didn't get quite down to this level. This is the low that was set on Wednesday, but you can say for right now, this 100 held, even though we didn't quite come down to that point. Then we look at a moving average rainbow, and I usually only cover this in the deep dive video, but this just gives you a bigger picture look, even at a short-term time frame, where we had come down below the rainbow, and the lines are starting to get all jumbled up because this goes from 10 to 50 periods. And then we started to come back up. The more we can stay above this, the more the lines will turn back up and smooth out the way they were before when we were seeing a really solid uptrend. And we look at an intermediate term rainbow going from 50 periods up to 100. We came down in here. We didn't last all that long in here, so we bounced up out of that. And because it didn't last very long, the lines didn't start to really roll over. They budged a little bit here. But again, the longer we can stay above this, the more the intermediate term trend will remain positive. Then we look at the long-term trend. We also came down into the rainbow, didn't stay there very long, bounced back up. These lines are still pretty much continuing to go up. We look at the Chaikin money flow, another smart money indicator. Now, this is a little bit of a warning sign here. When you look at the green, this is a histogram, and it's positive because it's above zero. But we had an up day on Friday, but you notice this Chaikin money flow actually declined, and the red line's rolling over a little bit. Not a reason to freak out, but just something to be aware of for right now, because our other smart money indicators are still looking positive. But we just want to keep an eye on this one. The Chaikin oscillator. A week ago, it was negative and below zero and declining. Now it crossed back above zero, turning it positive, and it's continuing to go up. And it's not up to this red line yet, where sometimes this can be an extreme reading. So taken together here, this is positive. And then another smart, not, this isn't smart money, but this is a primary indicator. We were negative with the red line above the green line a week ago. Well, the red line was declining, the green line was coming up. We're just barely starting to see a cross here with the green line going back above the red line. It'll be even more positive if we cross above this one level here and continue to go up with the green line and see the red line still declining. So right now, this is going from negative and it's potentially turning more positive. Then I do a simple moving average of the open, high, low, and close based on 20 periods, and that produces this little mini rainbow. Even though we fell down below it, the lines were still continuing to go up. We were able to get back through this, and sometimes these act as resistance, and they did here for a couple of days. We hit this level on Wednesday, then we just barely cleared it on Thursday, and we were able to get above it on Friday, and the lines are still going up. So this is also confirming that the short-term trend is looking positive for right now. And we look at an advanced decline line for the S&P based on a cumulative basis, and this is continuing to go up and breaking out above this previous high based on price, also just barely breaking out based on volume. We weren't seeing that before as we were going up. So this is looking more positive for the S&P. We look at those stocks inside of the S&P above their 20-period moving averages. We actually dropped below 50. That's when it turns this negative. We cross back above 50 and we're going up. That also confirms the short-term trend is positive. The 50-period moving average did decline, and now it's going back up, and it's still positive. The 100 is positive, and the 200 is also positive. Then we look at a weekly chart here of the S&P, and we were able to close back above this R2 level here. And this is a long-term pivot point. And you can see back in time, these pivot points really can come into play. Well, the fact that we're above this, even though we haven't set a new all-time high yet, is encouraging, at least for right now. The McClellan oscillator had dropped below zero and was turning negative. This past week, it went back above zero and it's turning positive. When it's above zero, the McClellan oscillator dictates the summation index, which is this next chart. We're turning back up based on price. And we had a little bit of a heads up. And if you were watching the daily videos, you saw this. We started to turn up with volume before we turned up with price. And now we can't always take that as being concrete evidence because sometimes volume will deviate from price and that's a false signal. We need to use other charts to actually confirm things. But now we're going up with price and up with volume, so we're turning more positive here. We also dropped below zero with the McClellan oscillator, and then we came back above zero and we're going up. When we're above zero, the NYSE summation index is turning back up based on price and barely turning back up based on volume. Excuse me. Now, the Swenlin trading oscillator was kind of mixed to negative a week ago. Well, it's turning back up and going above zero based on price, and it climbed back above zero based on volume. And if you kind of eye this a little bit, you see the volume's going up a little bit more quickly with more velocity than what we're seeing with price, and that can be positive. We went from negative back over to positive with a parabolic SAR. And this is another primary indicator that I use. But the momentum is improving and some parts are turning positive, but we haven't quite switched over to positive yet. The slope oscillator is starting to turn up, but it's still negative and below its midpoint. The TSI, another short-term oscillator, is actually crossing back above its moving average. We're seeing an improvement with our three intermediate-term oscillators, the MACD, the PMO, and PPO, but they haven't quite crossed positive yet. The long-term oscillators, the TRIX and KST, they're flattening out here, but they haven't really started to turn up yet. But they are showing signs. All of these are improving for right now, signs of improvement. This is something that was a little bit of a concern to me. This is the bullish percent index. This is also an indicator that I really like, and I call it a primary indicator. This measures the point and figure buy or sell signals inside of the S&P. It's not moving average based. It's not an oscillator. It uses a different way of calculating whether we're going up or down. Well, we were going down here even as the S&P was going up. But then for a while, we were going up here while the S&P was going down. That just showed that the rest of the S&P was holding up fairly well. And we weren't really going up all that much when we saw the reversal midweek this past week. Well, in Friday's session, we did see this really going up. Now, when we get above the green line, that means we're looking overextended. Now, and we can even go higher than the green line. But this is going from being a little bit cautious to now looking more positive. We also have a bullish percent index for the NYSE. That is going back up and above 50. That's positive. And the NASDAQ 100 bullish percent index, it actually gone negative. It dropped below 50. Well, now it's starting to go back up. This means that the mega caps have been participating in this upward move. Usually the mega caps and the semiconductors, they're the ones that really drive the indexes higher. And those stocks are in the NASDAQ 100 as well as the S&P 500. We look at the new highs, new lows. This is a daily score here. When we're above zero, we're positive. And then this red line is a 50-period moving average, which I also displayed down here just to make it a little easier to see. We're still declining with this. This takes a while for this to turn. And then I have that same chart just showing it a little different way. You can see where we're still declining here. It's positive since we're above zero, but it would be even more positive if we start to turn and go back up with this chart. And then the 2-year yield has been going down, and usually interest rates going down is positive for stocks. Well, we want to look at the context here, and I'm going to be mentioning that a lot, And I also brought this up a lot last week. We want to know, why are interest rates going down? Is that a good thing or is that a negative thing? Because it can be both positive and negative depending on the context. Well, we're going down with the 2-year yield, which lately has been giving some support to the S&P going higher. And then we look at a cumulative advanced decline line on the NYSE based on price. We're breaking out to a new high. We're also breaking out with a regular NYSE advanced decline line. And then we look at the VIX, and it's been coming down. We're below 20. When we're above 20, that's when we get concerned. We're going down and closing with the line chart, and we're also dropping below the moving averages here with the bar chart. And then we look at the VIX of the VIX. When the VIX is going down, typically the VIX, or the volatility of the VIX, is also going down as well. And that just means there's less fear in the market. And the momentum for the VIX is also rolled over as measured by the MACD, and it's starting to go down. So we're seeing fear trending lower currently. Tom Bowley did this. He's with stockcharts.com. He also does another site called earningsbeats.com. The lines that you see here, this is a weekly chart of the VIX, but the VIX is updated, but this is almost a year ago that he did some research and figured when we're at 20 or below, this is when we see positive annualized returns. The lower the VIX is, the better the annualized returns. Well, when we go above 20, that's when we start to see negative annualized returns. Well, we're coming down now. We closed at 16.56 for the week. We're coming slowly back down to this moving average. And this is more positive for stocks if we can stay at this level or even decline further from here. We look at a risk off versus risk on ratio, and this is starting to go back up. It had been going down a week ago, which was more negative as the market was getting in a risk off type position and getting into more conservative stocks. Now it's starting to go back up. And if this continues to go up, that will be positive for stocks. Then we look at a ratio between bonds and stocks. When this is going down, that means bonds are underperforming. This big spike up that we see, that was right at the beginning of August as the market was freaking out there for a few days. We started to come back down and looking more positive. Well, then as bonds were still going up and stocks were starting to go down, this ratio started to go back up. Then after Wednesday, or during Wednesday, we saw this start to turn and go back down. We're still down at the 50-day moving average. What we want is this to continue to decline if we're more positive on the S&P 500. Then we break this out with the common stocks with the advanced decline line, not quite back to breaking out of this previous high. We're actually breaking out a little bit here based on volume. That could be positive. When volume is leading price, that can often, not always, but can often be positive for the broader market. And if the broader market's doing better, then the S&P tends to do better. And then here's the other regular NYSE advanced decline line, also breaking out to a new high. I have a couple of different NYSE advanced decline lines because they're calculated in a slightly different way. We look at the new highs minus the new lows on the NYSE. We're also above zero, looking positive and showing a really good reading after Friday. We look at our advanced decline lines, and We're above the moving average with the NYSE common stock and going up. We're going up with the S&P. We're going up with the mid caps. We bounced off of the moving average. We actually went negative with the small caps, and we were able to come back up and cross above the moving average with the small caps. So that's looking better. Excuse me. And then this is a long-term trend line going all the way back to the 1987 crash. We're well above this trend line. So we're not really in any danger at this point of hitting that. We look at a ratio between the S&P 500, which is a weighted index, versus the equal weight version of the S&P 500. And you can look at this a couple of different ways. When we were really going up here, that means the big stocks, the mega caps, the Magnificent Seven stocks, they were really driving things higher. And everybody was complaining. It's like, if you don't own any of those stocks, you're not doing very well right now. Well, then we started to come down with this ratio, meaning that the equal weight was at least doing better than the weighted version of the S&P. And we started to go back up this week. We were down a little bit on Friday, but if we want to see the S&P going up, we need the Magnificent Seven, we need the semiconductors, we need the really big stocks to really drive the index higher. So we want to continue to see this going up. The NASDAQ, this is positive because we were below the 50-day moving average. We were able to close above it on Friday. We also recaptured the 50-day moving average with the NASDAQ 100. And the stocks in the NASDAQ 100 are also in the S&P. And the momentum for the NASDAQ 100 is starting to turn more positive. We're crossing back above the moving average here. It'll be even more positive. This is the PPO, the percentage price oscillator. If we can cross back above the midpoint and turn positive, that would be more of a confirmation that things are looking better. And we were able to get back above these moving averages here with the QQQs, which is the ETF for the NASDAQ 100. Small caps came down to the 200-day moving average and bounced up off of that. We're able to get back above their 50-day moving average and above this pivot point. Okay, that's positive, and we're in an uptrend. But we haven't broken out above these previous highs yet. There's been so many false signals this year with the small caps. They go up and then give it back, go up and then give it back. What's going to happen this time? We'll be watching that. Here's another small cap index, the Russell 2000, crossing above 50 with the RSI, above the 50-day moving average, and turning up but not quite positive with the MACD, showing that the momentum is improving but hasn't gone positive yet. This is a ratio between small caps and the tech sector. When this is going down, that means the tech sector is outperforming. We were a little bit concerned here because the small caps were outperforming tech. If we want the S&P to go up, tech is a huge part of the S&P and a huge part of the NASDAQ 100, and tech needs to really do well. Well, if this is going up, that means tech isn't doing all that well, and it's still kind of going up here, and we're in danger of seeing a golden cross with this ratio. So we'll be keeping an eye on this. You could take some positive things away from this. The longer term trend has been down, but you could take some negative things here that we're going back up and we're potentially seeing a cross here. The mid caps were able to get back above their 50-day moving average and above this pivot point, but have not broken out above these previous highs yet. The Wilshire, a broad market measure, was able to get back above its 50-day moving average. It has not set a new all-time high yet, but this is showing a lot of improvement. This is a total U.S. stock ETF, also back above its 50-day moving average, but not at an all-time high, at least yet. Then we look at a ratio of the Qs, the NASDAQ 100 to the IWM, which are small caps. We're right around this blue line here, and that I'm still taking that as positive. If this ratio, excuse me, really continues to go down, that's going to be more negative. You can see what happened back in 2000. We hit a high level and then just tanked after that. That's what the perma bears think is going to happen. But we've been chopping around this level right now and even going to a new high here. And this really big move down hasn't developed, at least yet, but it could. And then the financial sector came all the way down to its 50-day moving average and now is bouncing back up off of that. We want the financial sector to be doing well, but it was also doing well back in 2007. And then 2008 was the great financial crisis. So we just keep an eye on this, see if we can get some clues if things are really starting to deteriorate in the financial sector. The FANG index was able to get back above its 50-day moving average. That's looking better. We're able to get back above this longer term trend line with the FANG index, but we're still below this shorter term trend line. So we're improving, but not full blown positive yet with this chart. And the market is still anticipating a soft landing. We do a ratio between the S&P and 3 to 7 year bonds. That was in a lot of doubt here as we were coming back into the rainbow. Now we're not out of the rainbow yet. We're coming back up and improving, but it will be even more positive if this continues to go up from here. And then we look at the S&P 1500 and compare it with 1 to 3 year bonds. We're starting to come back up out of the rainbow. We look at another broad market ETF and compare it with further out bonds, 3 to 7 years. Not quite out of the rainbow yet, but improving. The tech sector to 3 to 7 year bonds coming back up, but still inside of the rainbow. And then we look at a ratio between the NASDAQ 100 and the Dow coming back up to these previous high levels back in 2000. And this is sure the perma bears thought when we got back up to this level, and that's where we hit back in late 2021. And then things fell apart in 2022. So we want to keep an eye on this, but for right now, this seems to be holding up. We look at a weekly chart of the NASDAQ 100. We were able to get back above this trend line going back to 2009, longer term improving again. We look at the 10-year yield, and the context that I'm going with right now is that interest rates going down is not because the economy is falling apart. It's because the Fed's going to come in and lower rates just because inflation appears to be under control, and they're trying to help stimulate the economy. That's the current context. Now, if we start to get some weak employment reports and we start to see a lot of weaker than expected economic reports, that's going to change the context. But as of right now, we tried to go into that negative context at the beginning of August. But then that only lasted a few days, and we went back to this idea of a soft landing, that the economy's not falling apart. And until we see the evidence to prove otherwise, people can come to any conclusion they want. But we look at the data, we look at the charts, and the context is that interest rates going down is positive for stocks until that scenario needs to be changed to a negative scenario. And we also look at the 1 to 3 month T-bill, which is cash, and we compare it to 3 to 7 year bonds. What is the context? We're going down and we're in a downtrend. Right now, that appears to be positive. The context here, 1 to 3 year bonds compared to 3 to 7 year bonds. Also, for the most part, going down, that is positive until we see things changing more negative economically. We look at the QQQs, the 3 to 7 year bonds. We came down to the 250-day moving average, bounced up off of that. We're still in the rainbow, but now we're going up. We look at the Eurozone just to get an idea how is Europe doing compared to the US. We came down to the 250 period moving average, bouncing up here, not improving quite as much, but looking a bit better compared to 3 to 7 year American bonds. Home construction, this is quite encouraging. They like lower interest rates. It's a very interest rate sensitive environment there. And we've been coming down into the rainbow, seeing a little bit of apprehension. Now we're starting to go back up. We look at a broad market measure of a 5-period moving average of the highs minus the lows. We're above zero. That's still holding together, suggesting that the broad market is positive. And then we look at TIPS, which are Treasury inflation protected securities. Back in 2021 into 2022, these were outperforming because interest rates were going up and inflation was going up. Now we're starting to kind of go sideways, but lately we've been coming down. We see a death cross here with this ratios. And the context is that we're still doing okay economically until that changes. And for the most part, it went up a little bit here on Friday. But for the most part, it has been coming down, and that's more positive for stocks. Large cap growth was able to get back above its 50-period moving average after getting down below its 100-period moving average. Earlier in August, it came almost down to its 200-day moving average. So this is showing an improvement here. We look at a ratio between the semiconductors and the Dow. This was a concern. We were going down. We were below this blue line, but then it's semiconductors that really came in and helped the market to go higher Wednesday, Thursday, and Friday this past week. So now we're starting to see this ratio going back up. But if this continues to go down, that's going to cause us some concern. Now we look at the negative side. There's not as many things there. Where a week ago, the whole list was negative, and there was a very short positive list. We're still negative here with sentiment. This is the fear and greed index put out by CNN Money. where we're still just a little bit below 50. Now, when we get down below 25, this is when everybody's pessimistic, everybody's selling, nobody wants anything to do with the market, they're afraid it's even going to go lower. That's when we look to come in and start buying. Goes totally against your emotions. When we're up here at 75, we're a little less leery to buy here because that means the market's a little too happy at that point. But while we're going up or while we're going down, we tend to ride with that. Well, we were coming back up after the big dip that we saw in early August and looking better. We got back above 50, but then we started to see some weakness a week ago and we were dropping down with sentiment. We are improving right now, but we're still below 50. That's why I have this on the negative side. 50 is the line between positive and negative. And we're showing an improvement here with large cap growth versus large cap value, a 10-minute intraday chart. Now, they're both improving. Both the red line and the blue line are going up, but we want to see the blue line above the red line to be more positive. You see back here in June when the blue line was above and the red line was kind of going sideways, the market was just screaming higher at that point. And the TTM squeeze, I know a lot of you that watch the videos that I do, you use the TTM squeeze, and this is another momentum oscillator. This is a little bit of a concern to us because we've been going back up, and even though the TTM squeeze has stopped going down, it's still negative. We want the TTM squeeze to turn and go back to a lighter shade of blue. That would make this more positive, and it hasn't turned positive at least yet. And we look at a growth to value ratio for the S&P. This is what I focus on the most. Now we are improving and we're coming back above the shorter term moving average here, but we need to see this improve. We need to see a breakout above these previous levels here. So it's looking better, but not full-blown positive at least yet. We also compare a growth and value ETF. This is really starting to show some weakness, meaning growth was underperforming. Well, we're starting to improve, but we're still negative here. And we look at the small caps growth to value ratio. It actually declined on Friday, and small caps had a pretty good day. That means value outperformed growth, and that's why this went down. Overall, we've been seeing a decline of growth versus value for the small caps. We were flat on Friday, but declining overall with the mid cap growth to value. And then I showed the S&P growth to value. It's looking better, but it needs to look even better than it is looking right now. We're seeing some improvements here with the Qs to S&P growth to value ratio coming back up to its moving average. And even though it's been really frustrating in 2024, discretionary to the S&P is improving here and actually looking a little stronger than the other areas. And we came back above the moving average when we look at large cap growth versus large cap value. And so the large caps are actually looking better now. We're coming back up to a declining moving average with the mid caps, and we actually decline back down to a declining moving average with the small caps. So there's some concerns in this chart. We want to see all three of these going up above an advancing moving average. We look at discretionary versus staples. It's improving, but not breaking out. So we've been seeing this bounce around, looking like it was improving, only to have it fall back down. So that's why it's on the negative side here. Now, this is positive on one hand because we're near an all-time high with the S&P equal weight, and that's a good thing. But when we look at the QQQ equal weight, we're not setting a high. There's a non-confirmation here, a negative divergence. It would be more positive to see this continue to go up and set a high if the S&P equal weight is also able to set a new high. And we're concerned about the transports. The black line is the Dow, the red line are the transports. It would be more positive. You see other times when the red line's above the black line, even though they're on different scales, this just means that the transports are outperforming. They just haven't been doing that in 2024. We look at a ratio between the small caps and the S&P. They were starting to really come up here, but then they fell back. And even though they're improving a little bit, longer term, the small caps are still underperforming the S&P. We look at a ratio between the staple sector, which is defensive, and tech, which is growth. Now, this is showing something that's more negative, and that's why it's on the negative side here. We're seeing a golden cross here with this ratio, where the staples, when this goes up, that means staples are outperforming. Even though they're declining right now, this cross is a bit of a concern to us. We haven't seen that since going back to the end of 2022 into the beginning of 2023. Is this suggesting that the market is becoming more defensive or getting ready to decline? The S&P to utilities ratio, not really moving around all that much. The utilities have been doing well and the S&P's been doing well, but this ratio is not showing that the S&P is outperforming the utilities right now. And the staples. Now, this has been coming down, but we want this to continue to decline. That means the S&P is outperforming staples, and staples are another defensive area of the market. We want to keep an eye on the jobless claims and just see how the employment situation is unfolding, because we're not going to get another employment situation report now until the beginning of October. And there's other employment data that will be coming out later, early October or so. So really the main thing that we can keep an eye on here is what comes out every week. And the 10 to the 2 yield curve is still uninverted here. Now, there's a lot of doom and gloomers out there that say once this happens, the ticking time bomb is set and the market's going to fall apart. And they may be right, but they also may be wrong. We just want to look at the charts. We don't want to go with any conclusion that we've reached of what's going to happen down the road. We just evaluate this day by day by day and then reach our own conclusions based on what we see. But we're still looking regular again here with the 10 to the 2. This was the first one to go inverted, and now it's the first one to come back and be regular again when you compare it to the 10 to the 3 month. It didn't go inverted as quickly, and it still has a ways to go to get back to being uninverted, if that's even a word. Now, this is something else we're watching, the 3-month yield. You notice what happened back in 2007 into 2008? We were starting to decline, and boom, we went into the great financial crisis. We don't know if that's what's going to happen, but we're seeing this really decline here. Now, for right now, the context looks okay, but we're going to be keeping an eye on things and watching our charts to see, is this decline meaning that maybe things are going to start to weaken going forward? We want to keep an eye on oil. We're still below 70, but that's mainly for geopolitical reasons if things really escalate in the Middle East. And utilities, a more defensive area, but you could also call this growth because of this green stuff that's going on. And there's going to be such a need for electricity. Is this growth or is this more defensive? If you see back at the end of 2021, this was really in a solid uptrend here. And then we went into 2022 and the utilities held up pretty well, but the market fell apart. Is that a signal that things are going to get more defensive? We don't know yet because this has been going on for a while and it really hasn't led to anything to this point, but that could change at any time. Staples, also a defensive nature. Look at how these things are just really screaming to the upside in a really solid uptrend. And if you go back to the end of 2021, they were doing really well. Also, they saw some dips along the way, but then while the market was really going down, you see how the staples, they declined too, but they held up better in 2022. Well, this uptrend is a little bit of a concern to us because this could mean that at some point the market will turn more defensive. But this has been going on now for all of 2024, and it hasn't really led to much, at least yet. And then we're watching this. This is the spread between the risky and not as risky bonds, and this is an inverted chart in the middle. To be more positive, we want this chart to go up. The fact that this is going down is causing us a little bit of a concern. I plotted here with the S&P and the VIX because this is kind of like a sentiment gauge here. And if this is continuing to fall, that would be more negative for the market. And we look at utilities, also just screaming to the upside here. I thought we already looked at those. All right. And then healthcare, another defensive area, also holding up fairly well, a defensive area. And the staple sector, again, if you didn't see it here the first time. And then we want to keep an eye on the dollar because it's in a downtrend, not only here on the daily chart, but also on the weekly chart. And then we got this thing called the Hindenburg Almond. And all the perma bears, they are partying this weekend. Now, a lot of the perma bears, at least a few that I kind of pay attention to, I just read their headlines and their spam emails. They declare it whenever one of these conditions are met, but there's really 3 conditions that need to be met for a Hindenburg Almond. And the nice thing, if you want to pause this and read through this, you can. But stockcharts.com has an indicator that takes all 3 of those criteria and puts them together. We've seen a confirmation now. The first one was triggered on September 5th. The confirmation was triggered on Thursday, September 12th. We had until October 3rd for the confirmation to occur. Okay, so we're watching this. There's other times, and it will be even more valid if we see more spikes up like this, because this was right before the COVID crash. All right. And then this was right at the end of 2021 before things went into 2022. Now, it doesn't necessarily mean things are going to fall apart, but it doesn't not mean that either. So we want to be aware of this. Things are looking pretty positive right now, but just a week ago, we were looking really negative, and now we're looking positive. So things can change quickly. That's why I really emphasize watch the daily videos that I do here. But this is now a confirmed signal that we just want to respect and pay attention to. Thank you. I really hope you found this helpful. I hope you have a really good weekend, and I hope to talk to you in the next video.